Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. I want to touch on Vancouver, a little bit what I'm seeing from like a feet on the ground perspective, and then going to jump into the Canadian national housing market as a whole, and then basically tying that all in together as usual. But again, a little bit more of a focus here at the end on the national housing market, as I promised you a week ago. But looking at Vancouver, I just find it interesting, really actually just fascinating. I mean, clearly the market is bad. We had a 33-year low in home sales last March, so there's really no like trying to pretty that up and make it look nice. It is what it is. But just to see from a feet on the ground perspective, I had 3 offers last week alone, all basically fall apart because of sellers' expectations just being completely unrealistic. I basically brought to the table, 3 different buyers, different properties, all, in my opinion, very fair, competitive offers in this market. And one of them, a $2.5 million purchase price, fell apart because the seller wanted an extra $25,000. And so it's things like that where you can see this is the reason why that we have a 33-year low in home sales. It just hasn't registered in a lot of homeowners' heads that the market has changed, and it has changed significantly. If you haven't figured out that you have a 30-year low in home sales, and you've not only that, but in that time period you've added about 1 million people to the population, should be a very obvious signal. So basically, like what you're seeing for like homes that are actually transacting are homes that are basically almost like forced sales, a lot of it through the private lending channel, estate sales, or you see a home that's well priced in a very desirable area, that is actually is an attractive home basically in any market. So it's like a fight to quality. So if you have like a subpar product in like an average area, it is not selling. So that's really the case, and I think that this trend is going to continue. I can tell you right now, we're here 3 weeks into April now almost, and based on these sales figures, it will again be a 30-year low for the month of April. So it just continues. This is a real estate housing market where these things don't have V-shaped recoveries. This is clearly a prolonged downturn now, where you've seen really a weak housing market, particularly in the detached, for over 2 years now. Condos for a full year now. And this is the reality of the situation. So I think that there's going to be some fortunate sellers that are I think educated on the market, understanding of that, and having the right realtors on their side that can actually advise them properly in terms of what is actually happening in the market, not just from an emotional perspective, from like a real statistical standpoint. I have realtors countering me back at these valuations, and I'm saying there's not one single comparable sale to even justify your price. You're basically basing this price on pure emotion. And I was like, this is literally the reason why sales are so low. Like, what are we doing here? So the spring market that was basically hyped up and was going to bail every single homeowner out, that didn't sell over the last 6 months to 12 months, has really, for the most part, it's come and passed. February was a flop, March was a flop, and April's turning out to be the same. And so you really have one more month, which is May, and then you start to get into June, when seasonally real estate begins to slow down again. So yeah, that's what's interesting. Basically what I'm seeing is, we've talked about the private lending, and we're going to get into that from a national perspective, but Bejamin from CIBC recently wrote a report, and his thesis was saying, hey, we don't need to remove the stress test. We need to amend the stress test, and we need to look at these private lenders, which he argued that are ultimately creating more systemic vulnerabilities. And I actually agree with him. I am definitely a proponent of the stress test, but I think it should have been implemented years ago. Unfortunately, Canadians already have record amount of debt and record high house prices, where at this point, unfortunately, there's really no turning back. You're trying. The horse has already bolted the barn. So a stress test at this point, unfortunately. I think it is too late, but it is cooling the market. But of course, we're going to have repercussions because of that. And one of the repercussions that Tal is talking about is the tremendous growth in the alternative and private lending space. Alternative lending, which is basically a loan, a non-traditional loan outside of the banking system, basically like big six Canadian banks, credit unions, etc., is basically most of these loans are 1 year terms from either mom and dad giving you a loan, or basically mom and dad taking equity out of their home and then lending it out through mortgage investment corporations. It was basically a pool of investors. They pool their funds together and they've lent it to homeowners who can't get approved at banks. So you've seen this huge growth in the private lending space, and basically, as Tal points out, in the Greater Toronto area, alternative lending now makes up 15% of transactions. So, this is I think, is a systemic problem that you have. But we need to go back to what is the real culprit. The real culprit of this booming housing space is because you have a 20-year bull market where everybody just makes money either owning real estate, buying real estate, flipping real estate, lending to real estate, being a mortgage broker, being a realtor, being a contractor. So you have all this capital and this allocation into real estate, and that's why it's like, people in the finance space would say, it's basically a misallocation of capital. So you have all your capital going into really an unproductive, and I'm in the business, so I can say that. It really is like it's not productive in real terms for an economy. Like real estate doesn't actually produce anything of value. It's merely shelters. Like when you build a home, it's just a home. Like it doesn't produce anything. It's not like building like a factory or a business that continuously will produce something after the money is invested. So what you have is basically 15% of. And that's going to be similar in Vancouver. It's good, like whatever is in the GTA is in Vancouver. And I can tell you, all the foreclosures that are happening in Vancouver right now are in and from the private lending space. So you have basically these luxury homes, mostly detached homes right now because the values have dropped off so much. They're so illiquid that private lenders are not re-upping their terms, or they're increasing their interest rates. And so people are basically stuck in this private lending channel and they can't get out. And so, I'll just give you an example, and I've been pulling these titles, working with some other firms, basically pooling resources and looking at a lot of these deals. So I'm pretty attuned to the private lending space, but I'll just give you an example. And this is the funny thing, is because people always say, Steve, well, prices won't come down that much because people have so much equity and they just won't sell. And I always say it's never an equity problem. It's always a cash flow problem, and you'd be amazed of the financial literacy of a lot of people. They just somehow get themselves into debt, and I just don't understand where the money goes. So I'm gonna give you a prime example. School teacher owns a house on the west side of Vancouver. They own, in 2001 they bought the house for $700,000. So you're like, oh wow, well, great for the school teacher. They bought this house for $700,000. It's now on the market for $4 million. So you're like, oh my gosh, like this is like a teacher that is like a multi-millionaire now just because they bought real estate 18 years ago and have just become multi-millionaires. They bought one house, and now, so it's for sale for $4 million, and I pull the title and I look and I say, oh my gosh, this person has 4 mortgages on this house. And then you dig a little bit further. So they got 2 mortgages from TD Bank. They have a first and a second from TD Bank. They got a third mortgage from a local MIC. So there's your alternative lending space. The mortgage is for $1.65 million at 9.5% interest rate for monthly payments of $13,000 a month. And then they have a fourth mortgage of $200,000 at 12%. So basically, they're listing this house for sale for $4 million, and they have $3.3 million in mortgages. Unfortunately, the house actually isn't worth $4 million. It's probably actually only worth $3 million. So there really isn't any equity in the house, and somehow they've blown through after buying the house for $700,000, and the house inflating in value. Probably at the peak was probably worth $4.5 million. They've somehow managed to be underwater on this house. So you can imagine this scenario played out multiple times, because I do see it quite a bit, but particularly it's interesting because you see a lot of these situations are actually from people that bought like 10, 15, 20 years ago, that just somehow, basically, no joke of a lie, basically use their home as an ATM. And this private lending space, it works. Like it works beautifully, because like all that you do is the house continues to go up in value, and so you just continue to borrow more money, you fund your lifestyle. For whatever reason, things don't work out, you just sell the house for a profit, you pay off the lenders, you move on. But now, again, what we're seeing is we have this now for the first time in 20 years, we basically have a prolonged downturn where these 1-year renewals are coming up from this private lending space, and they reappraise the house and say it's not worth what it used to be. You've lost 15% equity in 1 year. We want our money back. And people don't have a way to pay this, because you can't refinance your home. So and basically, just to show an example from a national perspective, I mean, as the home prices go, so too does consumer spending. Consumer spending makes up over 65% of GDP. So you can see the correlation between the growth in home prices and the growth in consumer spending is really spot on. And so, again, any sort of, in my opinion, any sort of prolonged slump has significant knock-on effects. And so yeah, I certainly agree with Tal in terms of that this is potentially a systemic problem, but I just don't know at this point how you navigate and how you sort of fine-tune things, unless you basically have to try to keep this thing going. So I guess you just push prices even higher, and I guess you push the debt even higher if you can. That's really the only solution. Yeah, anyways, and then we'll just touch on the national perspective, just because I promised it. As much as we talk about Vancouver, it's interesting to see from a national perspective, and we talked about lending, but from a national perspective, what you've seen is there's still growth in certain areas of the housing market. So Vancouver's slumped on a year-over-year basis. Calgary, Edmonton down on a year-over-year basis. Still some growth up year-over-year in the Greater Toronto area, but the two ones that are leading the charge are Ottawa and Montreal. And so people always go, oh, like what's going on with Ottawa and Montreal? But it's like, if you actually talk to the banks and you actually understand how money's created, and you actually talk to the private lenders, the lending just shifts. Capital just moves, right? Like, if you're going to invest, like if you're a Vancouver real estate investor, well, like most people are looking at the market and saying, well, I'm not investing. Like, look, this thing's coming down. Like, what's the bottom? I'm kind of nervous. So they look like, well, where? I like to invest in real estate. Like, what market's going up? And so then you see Montreal, and it basically just accumulates more capital, and that basically propels banks to lend, because like there's a reason why the market's slumping right now. Like, the banks are really tight here in Vancouver. Like, they're cautious, they're nervous about the housing market. The banks act as investors, and so now they look at Ottawa and they look at Montreal and they go, well, stable employment, economy seems to be growing over there. Home prices look relatively stable. They're going up, which is the important process, right? Like, there's a lot of lending here in Vancouver as the prices were going up, because it's perceived as a safe investment. When prices are going up, banks will lend, and so the capital and the lending, in my opinion, has just merely shifted into these other provinces in Canada. I mean, that's just the reality. I mean, you look at there's negative loan growth in Alberta. And you can see that in the drop in home prices in Edmonton, Calgary. Like the banks don't want to lend there. Like everybody's like trying to get a job there. The economy stinks. So as a bank, there's a whole lot of risk there. And then as a borrower, like, do you really want to take on a bunch of debt when you're not even like that confident about the economy? So it really is just plain and simple. But yeah, it's interesting. I'd look at, obviously Vancouver and Toronto make up the large premise of real estate activity across Canada. Just interesting to see that the national home price index for the first time in 10 years actually dipped into negative territory on a year-over-year basis, declining 0.5%. But yeah, just interesting to sort of see the peaks and the valleys in the clearly in the real estate cycles that we've had. So that's what I've been looking at right now. Same old spiel as it has been for the last couple of years. But for me, from market perspective, feet on the ground perspective, just continue to be fascinated. Honestly, I wake up every day excited to go to work, as like tough and as bad as this market is in terms of trying to put a deal together. Just fascinating to watch that, like literally in unprecedented times, to be navigating this market, to be dealing with these kind of emotions, and just to see how people react, right? Like you literally have, like as I've talked about, you've had 30-year lows in sales, and like clearly some significant downwards pressure on the prices, and just to see how delusional some sellers are, and how truthfully I think how much bad advice there is out there. I remember hearing stories last year was when the detached market was bad, that people the realtors are telling the clients, I'd take it off the market, relist in the fall, and relist in the fall, didn't sell in the fall, take it off again, relist it this spring. Well, look at this spring. I've seen the same thing with single family builders. These guys build these homes on spec. They're not selling. Like I still want to make a profit. I can't even fathom taking a loss. And so now they're renting their house out on a 1-year rental term, like as if like there's going to be some sort of V-shaped recovery when they go to put the house in the market next year. I don't know. So anyways, that's all I got this week. A bit of a rant, bit of a ramble. But yeah, just fascinating times. Whatever side of the fence you are on. I think there's, as I said, depends how you want to view the market. I look at it and say there's tremendous amounts of opportunity here coming. I think it's a great time to take market share of the pie. In terms of navigating, you're seeing more realtors fall out of the market. You're going to see more builders fall out of the market, more mortgage brokers fall out of the market. I think as grueling, as tough as these times are, anyone that can sort of come out of it, I think is going to be very, very successful. And if you can keep your head out of the sand and actually pay attention to what's going on, and keep it data dependent, there could be real opportunities. But unfortunately, that won't be the case for everybody. But it is what it is. Anyways, hope that helped. Otherwise, see ya.